Welcome to the Deep Dive, the only place where we take all the homework you've been dreading, chew it up, and serve the pure insight straight to you.
We know why you're here.
Yeah, you're looking to build wealth, you want to take control of your financial future, and you've probably noticed that a traditional, stable job, it's just not the guaranteed path to retirement it once was.
That is the cold reality our core source material really hammers home. William Kirkhoven, who wrote this guide for beginners, he makes it plain. Developing multiple income streams, especially through smart investing, it's not optional anymore. It's essential.
But, I mean, if you've spent even 5 minutes Googling this stuff, you know, the internet is just drowning in noise. Everyone is selling the Holy Grail.
That one simple trick, right? Get rich by next Tuesday.
Exactly.
So our mission today is to cut right through that. We've distilled Kirkhoven's essential unbreakable rules. This is the foundational knowledge you need to stop chasing random tips and actually start taking the helm of your own financial ship.
Okay, let's unpack this then. We've got a journey with 3 clear steps. First, we're going to tackle the fundamentals, the vocabulary you need to even understand what's going on, and maybe more importantly, the psychological mindset.
The mindset is everything.
Then second, we'll look at strategy. How do you find an approach that actually fits your temperament? And finally, we'll dive into the 2 great schools of market analysis. So, fundamental analysis for filtering your targets, and then technical analysis for mastering that mysterious, essential art of timing.
When you're just starting out, rule 1 is just know what you're looking at. You need the language.
Right.
So if you own a stock, you own a literal piece of that company. If they do well, say, a huge, steady company like Keurig Dr. Pepper, you own a slice of that success.
And once you get that, the other language starts to click. So every company has a ticker, like KDP for Keurig.
Right.
And then you have volume. For a beginner, why is volume so important?
Volume is critical because it tells you how serious the market is about a price move. I mean, high volume suggests commitment from big professional money. It's not just random noise.
Okay. And what about the bid-ask spread? I see that mentioned for short-term traders.
You have to understand that. It's that tiny difference between what a buyer is willing to pay and what a seller is asking. And that little gap, that's your friction cost. If that spread is wide, you're already starting in a hole profit-wise.
Then you have the basic price points: open, close, high, low. But Kirkhoven pointed out a really crucial psychological trigger that I think a lot of people miss: the 52-week high and low.
Yes. It's not just the year high, it's a rolling 52 weeks. And when a stock breaks that level, it's a huge psychological signal.
How so?
It suggests that for an entire year, basically no one who bought that stock is currently losing money on it. That feeling of, collective success. It often pulls in new investors, and the price can really accelerate. It's momentum chasing money.
We should probably also touch on the other instruments out there. You have Forex, the currency market.
Essential, but very complex, not for beginners. Then commodities. Things like copper can be a sort of barometer for the global economy, and gold is still that classic safe haven.
But the source gives a really stark warning about one asset class in particular: cryptocurrencies.
Right. And Kirkhoven isn't arguing with the technology itself. I mean, the blockchain is revolutionary, no question. But his caution is very clear.
That they're more for speculation.
They function better as a speculative tool than a proven long-term investment asset. They just don't have the same valuation mechanisms. You can't look at a PE ratio or sales growth for Bitcoin. You're betting on adoption, not on, inherent business value.
And that separation between speculation and investment, that leads us perfectly into the real foundation of all of this. Rule 2, which is simply know yourself. Because the critical difference between the investor who succeeds and the one who goes broke, it's rarely the system they use. It's always them.
It really is. It all comes down to one question. Before you even think about what you can win, you have to ask and answer honestly. What do I have to lose?
It sounds so simple, don't it? But really think about that. If you put your last $10,000 into the market and you haven't mentally accepted that you could lose half of it, every little price drop, every nervous headline is going to make you do something catastrophic.
And the practical fix our source recommends is to just separate your money. Physically separate it. If you have that $10,000, you divide it. Part of it is your survival fund, untouchable. The other part is the defined risk-accepted trading fund.
And that mental separation allows you to handle losses in the trading portion without it feeling like a threat to your actual life.
It stabilizes your decisions. It's a constant battle against our 2 primal enemies, right? Fear and greed. Fear makes you sell way too early.
Leaving money on the table.
And greed makes you hold a winning position way past its peak, hoping for that extra 20% when you already made 100.
So how do you fight that?
The book suggests rigorous self-awareness. It's not just a trading log of your entries and exits. Keep an emotional journal. Write down exactly how you felt when you panic sold that loser or when you felt euphoric on that winner. Spotting the patterns is the first step to breaking them.
And what about that terrible feeling of invincibility you get after a really good winning streak?
Yeah.
When you think you can't lose?
Oh, it's the ego killer. There's an extreme kind of quirky strategy mentioned. It's to deliberately take a small defined loss, say $100, after a huge win streak.
Just throw away $100. Why?
The purpose is purely psychological. It's to break the sequence, to humble your ego and remind yourself that you are not, in fact, infallible. It sounds insane, but that mental reset can be incredibly powerful.
Okay, so once you have the vocabulary and a firm grip on your own psyche, now you're ready for rule 3. Strategy. And this is where a lot of beginners go wrong, right? They try to force a style that just doesn't fit who they are.
That's the link back to rule 2. It's all connected. There is no single best strategy. There's only the best strategy for you, and there's a huge spectrum of them.
On the riskier side, you have things like buying on dips. People love the idea of buying low.
They do, but if you don't have deep fundamental analysis to back it up, a dip can quickly become a free fall, and then you're forced to double down just to average your cost. That takes massive resources and, frankly, nerves of steel.
Then there's the bear market strategy, buying when everyone else is panicking.
Which requires immense faith and patience. It often only pays off years down the road. It's really a strategy for people who have a lot of cash on the sidelines and absolute conviction.
Okay, so on the complete other end of the spectrum, the lowest stress approach is probably dollar cost averaging, or DCA.
It's incredibly popular, and for good reason. It takes timing completely out of the equation. You just invest a fixed amount at regular intervals, which minimizes worry.
But there's a trade-off.
The trade-off is your timeline. Our sources are pretty clear that to guarantee good results with DCA, you need a long horizon. We're talking 7 to 14 years.
Why that specific window?
Because you need to guarantee you've gone through 2 full economic cycles, including the downturns. That's what really balances out your average entry price over time.
And for the action junkies, there's day trading, in and out within the same day.
The psychological perk there is you sleep with no open positions, so no overnight stress. But the risk is immense. You have high transaction costs, and you risk missing the big gap ups.
Where the stock opens way higher the next morning because of news that broke overnight.
And if you're not in the market, you miss the entire move.
A strategy that the source material points out often gets faster results is shorting. Selling stock you don't own, betting it'll go down.
And the reason shorting can be faster than going long, it's just pure human psychology. Fear is a much, much stronger motivator in the market than greed. When a stock starts to drop, people panic and sell much faster than they slowly buy into a rising stock.
That acceleration of fear drives it down quicker.
Exactly. So at the end of the day, the takeaway for Rule 3 is this. Don't be something you're not. Match your trading style, your horizon, to your actual risk tolerance. If a successful trade makes you so nervous you can't sleep, you are way better off with lower returns and your peace of mind.
We have our mindset, we have a strategy. Now we get to the mechanics of what to pick. The author suggests this powerful hybrid approach, which starts with Rule 4. Fundamental analysis. This is the filter.
Think of fundamentals as the blueprint of the company. This is the analysis that gives you the belief to ride out all that market noise. If you know why you own a company, you won't panic when the stock drops 10% for no reason.
Okay, so let's talk key metrics. If you're screening a company's financial health, what are the absolute non-negotiables?
Well, continuous profit and sales growth year over year. That's the start. But crucially, you have to be wary of sudden spurts. If a company suddenly grows 50% in one quarter when they usually do 5%, you have to know why.
It could be a one-time thing, like selling a building.
Exactly. That's not sustainable business health. The next big area is liabilities and debt. Debt can be a great tool, but it can also be a time bomb.
So what are we looking for?
For immediate health, you want cash to be greater than current debt. Simple. Long term, you look at the debt-to-equity ratio. The target should be below 0.5.
And why is that so important?
Because if a company is highly leveraged, meaning lots of debt, and a downturn hits, that debt can be used as a weapon against them by the market. It can be a real killer.
Okay. And the third essential metric,
Return on equity, or ROE. This is one of the clearest signals of good management. It tells you how well the company is using your money, the shareholders' money, to make more profit. If ROE is going up, management is getting better at their jobs. It's that simple.
Beyond the numbers, though, there are these qualitative filters, and the biggest one Kirkoven talks about is barriers to entry.
Yes. If you can look at a company and clearly see why a competitor can't just pop up tomorrow and steal their business, you've got a winner. Think of the Starbucks experience. It's not just the coffee.
It's the atmosphere, the brand loyalty, the fact that there's one at every corner.
Or the high switching costs of moving from Apple's ecosystem over to Windows. These are non-numeric moats that protect the company's profits.
And the final qualitative check is on the management itself.
Look for leadership that is less noisy, less flashy. You want leaders who let the results do the talking. Think Warren Buffett. Management that's constantly on TV hyping the stock is usually a red flag. They're focused on the short-term price, not the long-term value.
So once we've filtered for a good company, we have to value it. The sources talk about models like DCF, discounted cash flow, and the PE ratio. In a market that changes so fast, how much weight should we really put on these numbers?
Almost none as a definitive trigger. That's a core insight from the guide. All valuation models, especially DCF, they are built on a whole series of assumptions projected 5-10 years into the future.
And in the age of AI and massive tech disruption, those assumptions are.
They're incredibly fragile.
So relying on a DCF model to give you an exact price target is actually dangerous.
I think it is because it gives you this false sense of security. The model should only be a sanity check, just to see if the current price is wildly undervalued or overvalued relative to an analyst's projections. It's a guidepost, not the destination.
Fantastic. So we've used fundamentals to filter what to buy. Now we turn to Rule 5. Technical analysis. This is the key to understanding when to pull the trigger. Our author calls this the mysterious arts.
He does. Technical analysis is basically the study of price and volume, the market's collective psychology. And Kirkoven's advice is to ditch all the complicated lagging indicators that beginners get obsessed with.
Like moving averages or Bollinger Bands.
Exactly. He insists you should focus on the raw power of price action.
Why is he so skeptical of those lagging indicators?
Because they just react to what the price already did. Price action tells you what the market is doing right now. For a beginner, the source says to just master 3 simple candlestick patterns that signal either exhaustion or indecision.
Okay, let's break down the story these candles are telling. First up, the shooting star.
The shooting star is bearish. It has a long upper wick or tail and a small body. The story is simple. The bulls, the buyers, they tried to push the price way up, but the bears, the sellers, took total control and shoved it all the way back down. It suggests the upward move is exhausted.
And the opposite of that would be the hammer.
That's your bullish reversal. It's got a long lower wick. So the sellers tried to crash the price, but the buyers stepped in with real conviction and drove it back up to close near the high. That suggests a reversal is very likely.
And the simplest shape, the doji, the little plus sign.
That's just pure indecision. The price opened and closed at almost the exact same level. It's a signal that needs confirmation from something else, like a strong support or resistance level, because neither side won that battle.
A really crucial point for beginners is using time frames correctly. The source puts a huge emphasis on analyzing from the biggest time frame down.
The longer the duration, the higher the conviction of the signal. So if your daily chart looks like a confusing mess, but your monthly chart shows a clear, strong downtrend, you have to align your trades with that macro trend. Ignoring the big picture is probably the fastest way to lose money.
Which leads to that classic trade-off, right? High time frame confirmation means low risk, but it also usually means you get a worse entry price. So low reward. How do you solve that?
The author's personal technique is to use limit orders. So instead of chasing a bad price or waiting and maybe missing the move completely, he just parks limit orders at levels where he expects strong support or resistance.
So you're sacrificing certainty for a better price. You might miss the trade if the price never pulls back, but if it hits your order, you get a much better entry.
Exactly. It's a deliberate choice between the speed of entry and the quality of entry. Now, just to help with visual analysis, we should mention that just recognizing wave structure, a series of higher highs and higher lows for an uptrend. That's incredibly helpful. You don't need to learn the full complex Elliott wave theory, but seeing the basic flow helps your timing.
And finally, let's touch on Fibonacci. If we want to keep our charts clean and our signals strong, which levels matter most?
Forget all the clutter. To keep it clean, focus almost entirely on the golden ratio. That's the 0.618 level for pullbacks and the 1.618 for projections. Historically, those are the levels that provide the cleanest, strongest confirmation points, just because of collective market psychology.
We've covered the rules, from the mind to the mechanism, and that leads us to Rule 6, consistent profits. This path is never fast, it is definitely not easy, but it's the only way to stable, lasting growth.
And this whole journey really rests on two final principles. First, don't follow the herd. You have to avoid that emotional contagion of tips and mass sentiment, especially during extreme fear in bear markets or, excessive greed in bull markets.
And second, trust your system, a system that you have personally built and tested and really internalized that gives you the belief, the conviction you need to act when everyone else is paralyzed by panic.
And that conviction is built through forward testing, live trading, even with small amounts of money. It's the only way you can really calibrate your emotional journal with your trading log and build that deep confidence you need to succeed.
So now, consider the contrast we've laid out. You can choose that slow, steady path of dollar cost averaging. You rely on a 7 to 14-year time horizon to guarantee your return. Or you can commit to mastering rules 1 through 5 and use analysis to accelerate your returns through strategic entry and exit points.
And here's the final thought for you. If you are working with limited capital and you have ambitions for truly exceptional growth, which path gives you the better chance? The commitment you make to mastering timing, to applying these analytical rules, that is the difference between slow accumulation and rapid wealth building. The challenge is clear and the reward is immense. Never give up.